let's work together to see how numbers in an adjusted trial balance get turned into financial statements. Piece of cake. Let's get over to the computer here and do it together. All right, on your screen we have the adjusted trial balance for Jan's Dance Studio Incorporated, and this is for the period ended December 31st, 2021. And as you can see here, our job is to prepare an income statement, prepare a statement of retained earnings, do the closing entry that's necessary, and as well as preparing a balance sheet. All right, so let's tackle the income statement first. Trial balances are great. The way to think about a trial balance is it's a rough draft of the financial statements. It's like if you're in a writing class, this is your first draft of the paper that you're writing. So really all that we have to do once we have an adjusted trial balance, once we've done all of our adjusting entries and we've updated all the accounts in the general ledger, we can take this adjusted trial balance. It's called adjusted, by the way, because it's after adjusting entries, and we're going to record the information that's in this trial balance. We're going to simply record it in the form of statements now, which means mechanically it's really just a lot of copying from one statement to the other. So if we scroll down here, we have the template for our income statement, and you'll notice there's a header at the top. We need to have the name of the company, the name of the statement, and then the period that we're preparing this for. So revenue is the first account that always appears in the income statement. And if you go back to the trial balance here, the first revenue account, the revenue account that you see is right here, studio revenue earned 165,000. So we are going to say oh, studio revenue earned and 165,000, 165. And then we're just going to continue this process all the way from studio revenue earned all the way down to income tax expense. Notice that the trial balance, the accounts are organized. So in a trial balance, we're going to see the balance sheet accounts first, and then we'll see the income statement accounts, and that's it. And within the balance sheet accounts up here at the top, we have assets, right? Assets run from cash through accumulated depreciation. Remember, accumulated depreciation is an asset. It's a contra asset, which means it has a negative balance in the asset section. And then our liabilities start here with notes payable. So we have notes payable all the way through to unearned studio revenue. And then finally, we have the equity accounts here, capital stock, retained earnings. Dividends is something that gets incorporated into retained earnings. We'll see that in just a minute. And then here we start seeing the income statement accounts, studio revenue earned, salary expense, all the way down to income tax expense. Okay, so I'm just going to quickly go through and I'm going to put all these income statement accounts starting with studio revenue earned. I'm going to populate the income statement with those numbers. All right, so I've copied over all the revenue and expense accounts, and now we're at this subtotal line item. This is called income before taxes. This is the studio revenue earned up here, 165, minus the total of these expenses. All right, so let's take 165 and subtract these amounts. So I'm gonna just quickly on my calculator, just quickly add these up and see what we get. And so I get 59,000 here for income before taxes. And remember, this is studio revenue earned minus 85 minus 3,900 all the way down through interest expense, and that gives us our income before taxes. Why do we do this? Well, because income taxes need to calculate how much you owe in income taxes, you need to know how much income you've made before you pay taxes. So once we do that, we would do a calculation normally, but in this particular problem, they tell us what the tax expense is. They say income taxes expense is 23,000. So I'm going to type in income taxes expense 23,000. And finally, my net income is 59,000 minus 23,000. or 36,000. All right, so that's our income statement. We're done. Income statement is done. Next thing, we have to do our statement of retained earnings. Our statement of retained earnings, just like any other statement, has the name of the company, the name of the statement, and then the period for which it's being measured. Retained earnings is this statement is meant to explain how retained earnings from last year gets rolled forward to this year. So we're going to go back up to our trial balance. We see that retained earnings is $40,000. So we're just going to put in $40,000 here for the first line. Our net income, we just calculated. So net income for this year was 36,000. So I'm going to add 36,000 here. Dividends declared, if we go back to the trial balance, dividends here were $6,000. So I'm going to subtract those, 6,000. And finally, we add up these numbers, and so we have 40,000 plus 36 is 76,000 minus 6,000 is 70,000. And this statement is also done now. So we're done part two. All right, next thing we have to do. We have to do what is known as a closing entry. A closing entry is this idea that all of these income statement accounts need to be reset so that they are ready for next year. Think about it this way. Say the Eagles running back, the Philadelphia Eagles, you know that I'm an Eagles fan. Saquon Barkley, the Philadelphia Eagles star running back, last year had over 2,000 rushing yards, right? Would it make sense if the people that track the stats for Saquon said, we began the next season, we're going to keep his yards from this season or the past season as the starting point. So this year, as Saquon begins his NFL season, he starts the year with already having 2,000 or more yards. Does that make sense? Well, if you're like me, you're probably saying, no, that doesn't make sense. Well, why not? Because you want to know not how many rushing yards Saquon had over 2 seasons. You want to know how many rushing yards Saquon had in 1 season, this current season. Same thing goes for the income statement. You want to know how much revenue, how many expenses this company had in the current year and in the current year only. We're not concerned about what happened last year. So what we have to do to get these accounts back to zero so that they're ready for next year is we have to zero these accounts out. If revenue has a credit balance of $165,000, we have to debit that account for $165,000 to reset it to zero. If salary expense has a debit balance of $85,000, we have to zero that out by crediting salary expense for $85,000. So we're just going to go through all of these income statement accounts, and we're going to do the opposite of their balances in the trial balance to get them back to zero. And so closing entry, it sounds complicated. It sounds like something that's hard to understand, but really all you have to do is do the opposite of what you see in the trial balance. So coming down to our journal entry worksheet, I'm just going to say for the first one, and by the way, closing entries are always done on the last day of the year. And we're going to say debit studio revenue earned. And I'm going to put the full amount as 165 in the debit column. Again, why the debit? Come back to the trial balance. It has a credit balance of 165, and the mission here for the closing entry is to reset this to zero. How do you reset an account that has a credit balance of 165 to zero? Well, you have to debit that account for 165 to make it go to zero. Okay, so I'm just going to follow the same pattern, complete the rest of the entry. I'm going to speed it up a bit, and then we'll come back and we'll discuss further. All right, so I have all the accounts listed here in my closing entry. You'll notice all the expenses that had debits in the trial balance are now credits. So we need to reverse these numbers by doing the opposite. Same thing with studio revenue earned. And if we add these up, if we add up all the credits, they will not equal the credits. or I'm sorry, they will not equal the debit. So the total of the credits here is going to be $129,000. So the total of these amounts is 129,000. That's the total credits. And over here, the total debits are 165. So we know one of the biggest rules for doing journal entries is the total of the debits have to always equal the total of the credits. So what's wrong here? What are we missing? Well, what we're missing is retained earnings. So we're going to credit retained earnings for $36,000. Why is that? Well, remember, what we're trying to do with the closing entry is to zero out all the income statement accounts and move those amounts into retained earnings in the balance sheet. This is what makes it happen. Hopefully this $36,000 number, it sounds familiar. Where did we see this before? Let's go up to the income statement. $36,000 net income. So what we end up putting in retained earnings in the closing entry ultimately is our net income. Okay? So this closing entry serves two purposes. The first purpose is to zero out all of those income statement accounts, and the second purpose here is to move the amount of net income into retained earnings. All right? Last thing here is we need to prepare a balance sheet. And this again is same process as the income statement, very easy. All that we have to do is take the accounts from the trial balance and copy them over into this format, and then we can call it a day. So let's go back up. What's our first asset account? Cash, 171,100. So we're going to come down here to our balance sheet. We're going to say our first asset is cash, and it was 171,100. Did I have that right? 171,100. Yep. And then my next one will be accounts receivable, 9,400. All right, so I'm going to speed this up. I'm going to speed run this, record, or show you how to record all these in the balance sheet, and then we'll come back and discuss. All right, so I filled in all of my asset accounts, and when I total these up, I get 202,000. Notice that accumulated depreciation, I said at the top of this video, accumulated depreciation is a contra asset account. It's in the excuse me, it's in the asset section and it has a negative balance. All right, let's move on to liabilities. All right, so I've added all my liabilities. They total up to 32,000. Last section here is we need stockholders' equity. Come back up to the trial balance. Stockholders' equity includes capital stock, which is $100,000. So capital stock is $100,000. 100,000. And lastly, we have retained earnings. And let's see if you remember, we already did the statement of retained earnings. So we already have this number. We don't go to the trial balance for this. We go to the statement of retained earnings. Up here, our statement of retained earnings says that this is $70,000. I'm going to put this in, 70,000. So total stockholders' equity is 170,000. And if you add that together with liabilities of 32,000, you see that we have a total liabilities and equity of $202,000, which matches our total assets, our balance sheet balances. I love it when it does that. And we are good to go. All right. Well, I hope you found this video helpful. I hope you understand how the trial balance can be used to make the financial statements. Take care, and I'll see you real soon.